Joining us today for this conversation are the Bank for International Settlements, Thomson Reuters Regulatory Intelligence, and the Federal Deposit Insurance Corporation, FDIC, moderated by PJ DiGianmarino, founder of JWG. It's my pleasure to hand over to you, PJ.
Thank you, Alessia, and thank you very much for joining us today. I would like to start just with a quick introduction by our esteemed panelists. Sultan, can we start with you, please?
Thank you, PJ. It's great to be here. So I'm Sultan Megji. I'm the Chief Innovation Officer at the FDIC. I'm a nearly 30-year veteran of artificial intelligence and advanced and emerging technologies, going all the way back to the first web browser, to the markets, done a couple of startups. And I joined FDIC here about a year ago to begin to build an innovation strategy, to begin to catch up on all the things that are occurring in the market and how to build a forward-looking regulatory agency.
Fantastic. Thank you. Fernando.
Thank you. My name is Fernando Restoy. I'm the chairman of the Financial Stability Institute of the Bank for International Settlements. Our role at the Institute is basically to support regulatory and supervisory authorities around the globe, actually to do a good job, to try to strengthen their financial systems. And for that purpose, we publish a number of policy documents, and also we offer training and outreach services to our stakeholders, which, as I said, are mainly central banks and regulatory authorities.
Fantastic. Last but not least, Susanna.
Thank you for having me here. Yes, Susanna Hammond, in prior lives, career heads of compliance, places like GE Capital Bank, Warburgs, HBOS, the dear old Halifax Building Society, as was. I joined Thomson Reuters about 15 years ago now, my goodness. And since then, what I do is I commentate and interpret regulatory change and the practical impact and ramifications of it. So hopefully we are able to explain to financial services firms around the world actually how to handle all of the change that is going on around them.
Thanks so much, Susanna. And for those that you don't know me, I am a reformed consultant who got into banking and then discovered this operational agenda around compliance, which we now call, the one we think about is RegTech. There's lots of ways to think about this panel, but it's a really fundamentally critical and important conversation. I come at it from a banking technology point of view. We can talk about fintech, regtech, subtech, but at the end of the day, there's one set of technologies that we use to and rely upon in this industry. And what I have always sought to do is create an independent, safe space for regulated and suppliers to come together to look at what they have to do to implement regulatory change. So my JWG runs working groups of solving problems. We're running a 170-person working group right now for global derivatives regulatory reporting, and we have a whole bunch of other conduct and technical agendas as well, of which this is one. So thank you very much for Thomson Reuters for bringing us here. The agenda we're talking about today is really, really big picture. The next wave of technology and data-centric obligations are upon us. It's no secret that we've all been locked down. We're all very dependent upon technology. It is a bit secret that we don't really know how to account for that risk. And that's the big change right now. We're going from an idiosyncratic view of how you manage operational risk on the bank's balance sheet to taking a much more systemic or systematic view of how these technologies are being applied and where the potential operational issues lie. And so fundamentally, they're unlike any other regulations that we deal with in banking. I could say anti-money laundering, and no matter where you sit, you generally understand more or less the requirements. They're kind of aligned more or less at the global level. When you get into AI, depending where you sit, you could be thinking a completely different view of life. If in the US, it's a very corporate view, and whatever the company does with AI is fine. If you're in Europe, it's a very human-centric view, and we have to protect absolutely everything that humans get involved with. And if you're out in Asia, it could be the state making all those decisions for you. So this is fundamentally a question about how do we bring it all back together as a global banking infrastructure, and no real economy has this level of challenge. So we have huge supply chains, everything is digital, and we need to manage things out in the cloud, and we have a very litigious environment. And what our research is showing is that there's this growing blind spot to technology risk. And really one of the answers here is let's think about the G of ESG as the governance model. And I think that's until we work out that data is capital and how we manage it fundamentally from a banking risk point of view matters, we're not going to get very far on this agenda. So there is light, there are paths towards here, but they're not straightforward. And we got to stop talking about the technical detail of the car engine, and we have to start talking about the driving experience in order to bring this all together. So that's what I hope to do with this panel. Thank you very much for putting up with me in my fast-moving moderation style. And please send questions in if you'd like as we go. But I'm going to start with the first of our three big questions that each of our panelists in turn will wrestle with. The first is, how are regulatory objectives adapting to address the new technology risks? Fernando, I'd like to start with you. Is the current regulatory frameworks accounting for technology and data risks sufficient, i.e. is data capital?
Okay, many thanks for this relatively broad question. I think in order to address it, probably we need to distinguish between two different types of risk associated to technological developments. The first type of risk have to do with the technologies themselves. And you mentioned artificial intelligence, and you basically mentioned other type of technological developments that can generate risk by themselves. But also we have actually to deal with the risk posed by the activity of the new technologically sophisticated players, like Fintechs or big techs, where they offer specific services like financial services, for instance. So on new technologies, I think risks stem essentially, or not exclusively, from from operational vulnerabilities that they can create, that are created by the intensive use of new technologies, particularly by financial institutions. And those risks are particularly important if they are provided by third parties. So we have this third party dependency, which is quite relevant. For instance, in the case of cloud service providers, but all financial institutions around the globe basically now rely on. On the second type of risk, the ones which are more related to entities, to the technological players themselves, we have to bear in mind, of course, that because of the business model they run, that typically leverage a lot on the intensive use of customers' data, of course, this actually raises personal data protection issues. And beyond that, large big tech platforms, which combine both data and technological superiority, have the potential to build positions of market dominance that can lead to an excessive reliance or excessive dependence, actually, of the economic and financial system on a few large technological providers, and also this could actually damage competition. And moreover, I think when those big techs issue payment instruments, such as, for instance, stable coins like Diem, which could be eventually of general use, risk may also affect consumer protection and eventually as well monetary integrity.
But before we go to those other types of risks, let me circle back on, if I may. So I understand the risk of the technology itself, the risk of the third-party supply chain, and the concentration risk of bringing it all together. But my fundamental question is, from a balance sheet point of view, are we providing the right incentives for managing this risk?
Right. Let me tell you a little bit about what is going on in the regulatory domain, which is the second and probably most important part of your question. I mean, you're right. I mean, regulation should be about controlling those risks. We have to do with the two types that I just mentioned. So what is happening now? Well, the regulatory framework has not yet been fully adapted to cope with the relevant technological risk, although I think it's important to bear in mind that some relevant initiatives are now being recently undertaken, right? So for instance, in operational risk, I think it's quite welcome that financial sector authorities are in the process of updating the regulations and supervisory expectations, typically following the guidance recently produced by international standard setting bodies like the Basel Committee or the Committee on Payments and Market Infrastructures or IOSCO on the securities side. But it's true that probably the boldest initiative is probably the one of the European Commission. The European Commission recently proposed the Digital Operational Resilience Act, it's called DORA, which includes specific requirements in respect to operational resilience to all different types of providers of financial services. And it also envisages a special regulatory and oversight regime for large cloud service providers. And this is quite a unique initiative because nothing of that sort is actually happening elsewhere. In what respect the second type of risk, I mean, the new tech players. Well, I think it's important to note that a number of entity-based rules are now being considered in several jurisdictions. This is certainly the case of China, where big techs are being subject to specific constraints to prevent anti-competitive practices or misuse of personal data. And they have also established actually a specific prudential regime for large big techs that offer financial services. Actually, they need to constitute specific financial holding companies which groups all financial activities that they perform. In the European Union, again, the European Commission has also proposed a specific regulatory regime for big techs aiming at preventing anti-competitive practices, including the introduction of data sharing obligations upon clients' consent. The US are somehow lagging behind, although there are already several initiatives for big tech specific regulation. In particular, I think I would like to stress the recent proposal by a US President Working Group on stable coins, which contains quite bold initiatives to severely regulate those instruments and the entities that they issue them. So in sum, I think the regulation is certainly in a state of flow. Many initiatives on the table, although of course they will have to grow in number and enter soon into force in order to prevent some potentially disorderly developments in the financial system and the economy at large.
Thank you. That's really great wrap up, and I appreciate there's many jurisdictional views you have to cover off, but there's certainly a flow is a great word, a way to put it. Sultan, if you could come off mute and let us know where you come at this from. Where are we in the thinking of the reconstruction of the FS infrastructure?
I mean, it's such a huge topic area, as Fernando just laid out. You know, it's hard for me, I think, to cover the same breadth that he just did. So I'll talk about it from our perspective at Fdic. You know, we account for, roughly speaking, 80% of the banks in the United States as a primary regulatory body. And, some of our statutes go back to the 1930s. And, that was an entirely different world, gold standard, paper money, things like that. And when you begin to look at what's going on right now, I'll highlight three areas that are critical for us. The first is around inclusion. We want to make sure that we're not leaving anyone behind. If you evaluate the current banking environment, I'm just talking about the United States, of course, we have millions of households and tens of millions of individuals who are either banked or underbanked. And that's something we need to do more with. And so we have to bring our regulatory perspectives up to date to make sure we're doing something about that. The second is a resilience question, right? It is impossible to have banking without technology. It is impossible for an institution to not take the resilience of that entity as a primary concern. And it's something we spend a lot of time on, every day we have a conversation about this in the system. And then the third is, of course, preparing for what's coming, whether it's more artificial intelligence or quantum computing or digital assets or any of these other activities. I take the point that Fernando made around concentration risk in big tech. We already have to a degree concentration risk in the United States. There are basically three companies that account for a tremendous amount of the banking infrastructure from a technical perspective in the United States. And so, we've been dealing with this interesting environment for quite a while. And so part of the mission of our organization inside of Fdic is to specifically look at not only looking at what we do currently and how to make sure that it's correct and fit for purpose and modern, but then also keeping an eye on the future. For so long, regulatory bodies are far too reactive. They don't do anything until they see it in an exam or they, read about it in the Wall Street Journal or the New York Times or on Reuters. But now we have to get forward on it. And so that brings an entirely new dialogue in terms of transparency, in terms of engagement, in terms of collaboration between the public sector and the private sector. And, our view is that it is impossible for the regulatory community to do this alone. We have to engage early and often. We have to engage with the private sector, with academia, with other governmental bodies, for us, not just in the US federal environment, but at the state level, at the European level, at the global level. As I'm also a member of Bretton Woods, and that, it goes all the way back to where a lot of these systems came into place. And it's a top to bottom, but also bottom up conversation.
It's interesting as we try to aggregate all these splinters, right? We can talk about cloud concentration risk, we can talk about AI, we can talk about data governance.
Yeah.
But at the end of the day, it's risk.
Yeah.
And it's almost like that tech risk conversation is becoming a business risk conversation.
Absolutely. And I don't think there's a way to separate them. Risk is risk, full stop, right? It's just the mechanism by which we are evaluating the entity to make sure that they have the appropriate risk management methodologies in place. But then also the things they have to pay attention to and that we have to pay attention to because of that are changing. Data is a huge component of that. The number of transactions per account, per month, year, whatever metric you use, has gone up by many orders of magnitude in the last few decades. And so having individuals staring at pieces of paper and written reports is not going to work. It's just not scalable. And so thinking about how we evaluate data in different environments is a critical function. I'll give you an example of something that we've spent some time on recently, which is zero knowledge proof. It is a fundamental way of evaluating and doing risk analysis on data that is not inside our walls. This is a great new area of research. We have academic partnerships working on it. We're looking at how to take technologies like this and put them inside of the existing regulatory environment. Nobody's throwing the baby out with the bathwater here. We have to iterate on these systems at a higher rate in order to ensure that we're having effective risk management conversations.
Yeah, and it's that higher rate and it's that global nature of some of these conversations that really comes to bite us, right? So when you're talking about AML, and everyone loves zero proofs and all kinds of homomorphic encryption and all kinds of great data sharing things that we could do, but everyone's scared of their AML obligations and their legal obligations vis-a-vis the customer. How are we going to break this knot if the regulator doesn't come in and say, look, it's okay?
Well, this is one of the hardest questions right now. And I'm sure you all know, and the entire audience knows that, the regulatory environment in the United States is not homogeneous. There are nearly 100 different financial services regulatory agencies in the United States. That is, there's a lot of different thoughts on this, right? I certainly can't speak for all of them or even most of them. I will say, though, that the great thing that's happening right now is it's dialogue, it's engagement. And so the thing that I think has really changed in the last 24 months is, as an agency, we actively want to hear from people. We want people to say, hey, we're looking at X. We're going to try this out. Some agencies have regulatory sandboxes, others have near field engagement. There are a lot of different ways to engage depending on what your regulatory obligations are. There isn't a single answer there, PJ. I wish there was. That would make everybody's lives a lot easier. But I'll tell you that the engagement right now is the best it's ever been. The dialogues are the most functional, most valuable they've ever been. And, for me, I look at this as one of the best times to either be in banking or in a regulatory seat like mine, because we realize that things are changing. We realize we have to do something about it. And there isn't a one size fits all solution. But that's why we're putting so many more resources into these discussions, because we have to engage early, we have to engage often, and everybody's going to have a different perspective on this. And we have to make sure that we're open to these diverse dialogues that don't look like what we've had before. I will put a little flag up here and just say, diversity isn't just about the consumer. It isn't just about, looking at making sure that the right banking products and services are out there. It's also a diverse community that now has to participate in the regulatory system. 5 years ago, the fintech versus bank discussion was incredibly contentious. Now it's a collaboration. Now it's all about bringing those diverse voices.
Yeah. Oh, look, and I'm a big buyer of collaboration. I think what I sense, though, out of the community is we've been collaborating now for a while around some of these reg tech, sub tech topics. And unless you make that bridge, you travel across that bridge from theory to practice and actually start seeing the returns in the business case, people don't stay in the room very long. I guess I want to turn to Susanna here. Susanna, what's your perspective? You've just done this 6th year of your report. What are you seeing firms considering to be those big challenges in year 6?
Yeah, the 6th report is the FinTech, RegTech and Role of Compliance in 2022. And it's truly global. I mean, 450 respondents from right around the world. And one of the many questions we asked them was what they considered to be their greatest financial technology challenge in the coming year. And as you might imagine, we got really quite a lot of answers. But the number one was data governance. And that's something all of us have already touched on. I mean, data is the new oil. That's one of the easy buzz phrases, but it's the strategic asset. And firms are struggling to a certain extent, or at least reprioritizing their approach to data governance. They have to make it a priority. They have to invest in how they deal with it. Because apart from anything else, the sheer amount of data is exploding. I mean, it's doubling every 2 years or whatever it is. So data governance is the #1 financial tech challenge for firms. Other things on that list was availability of skills. I mean, Sultan has sort of touched on that. I mean, look at all of those diverse products that are now being considered as ordinary and normal. And yet firms have to have the skills to handle that. And equally, to be frank, so do the regulators. So you have the firms and the regulators all looking for these people with the fantastic data scientist skills, artificial intelligence skills, crypto skills, whatever it is. But one of the challenges about availability of skills, well, I suppose two things really. One is which precise skills are going to bring the most benefit to your firm, because somebody who is an expert in artificial intelligence and making sure there's no bias in your machine learning isn't necessarily going to be somebody who understands the finer points of cryptocurrencies or stablecoins or whatever. They are different and distinct skill sets. I mean, they can overlap, but they are different skill sets. And the other thing, and this is diversity perhaps from another perspective, is the age thing. I mean, people who tend to be on the boards of the big financial services firms, and please forgive me for saying this, tend to be somewhat older, and they don't naturally have the tech skill sets that, say, my children do. And that is, again, a challenge for the firms themselves and to a certain extent, the regulators. Other things on the list, cyber resilience, which I suspect none of us would be surprised by, but if we don't get cyber resilience right, for want of a better phrase, all of this is a bit theoretical because nobody will trust anything in terms of the digital world. We have to make people comfortable that cyber resilience is a fact of life and you can be comfortable in the online world and it's all going to work. The other two things on the top 5, financial crime, which we've already touched on in terms of the money laundering and so on. And then, and this is really the topic I suppose today, regulatory approach. How are we going to have a regulatory approach that enables all of the benefits we would like to see out of this and actually minimizes my shopping list of challenges I have just gone through?
Yeah, the shopping list there's key for me. There wasn't a lot new in this year's list, and I've certainly, the data, the new oil, I've been hearing that for a decade, and we have the whole EDM council that's been out talking for 16 years about data. To me, what we're missing is the separation of roles, and the fact that most big banks, anyway, global banks, have recognized all these challenges, and they've said, we've got to stop trying to code this up every jurisdiction by jurisdiction with different compliance rules. And we have to move to model-driven compliance. We have to be able to have operations that we can tie back to the way the data is being processed and be able to prove that those controls are carried out. And I guess that's, when I step back and I look at it, that's the big shift going on, because in order to do that, you need to have common models. And you have to be able to model an enterprise, whether it be AML or it be regulatory reporting. And you say, this is how I think I should do it.
There is a very big piece around international coherence. And that doesn't mean that every jurisdiction has to have the same rules, but they should at least be coherent, particularly as they treat particular topics. I mean, one of the threads is, should all regulation be technology neutral? Well, it could, but that's very difficult to do considering some of the things that technology is now doing. And I think, I mean, for all of that shopping list of issues I've gone through, I think those still also apply for regulators. And when we asked the firms, what do you need the most help from the regulators, their two were data governance and cyber resilience. And that is an area I would suggest where international consistency of approach, coherence of approach, particularly at the supranational policymaker level, and then the cascade down, is absolutely critical. And unless firms then engage and help regulators make good regulation, good coherent regulation around all of this, we kind of start spinning on a hamster wheel rather than making progress, because firms themselves find this challenging.
And I was interested in your podcast, not this last one, the one before, about ESG. And in that the G standard. We've been out front for a couple of years saying, look, unless we get real standards for how we measure this risk factor K, and are able to get some credit for doing it properly,
Mhm.
we're never going to see the investment in this kind of platforms we're looking for. What's your perspective?
I think there needs to be a complete acknowledgement that the governance of ESG is without that, nothing else works. And the governance piece is something where there has to be huge interaction between firms and the regulators. Almost that for the firms to say, look, we are doing it this way. If it's not what you're expecting, please tell us now. And they have to be able to rigorously and reproducibly evidence why they have done what they have done and why that is the right thing to have done. Because almost all firms have to aim for good customer outcomes. However that's phrased in your particular jurisdiction, whether that's treating customers fairly or don't rip off vulnerable customers, whatever it is, you've got to be able to show you're doing the right things in the right way. And that's of benefit to the wider financial services firms. But I would also hook that back to increasing personal liability for financial services senior managers. And they have to understand that it's on them to get the governance, the G, right in their firm, even if that means asking some really quite challenging questions. I mean, undertaking, for instance, a skills gap analysis to how tech savvy your board is can actually throw out some pretty uncomfortable questions, because nobody wants to be sitting there thinking, I don't know enough about this. And that's the sort of thing that all needs to be woven in.
And it's not just people on the firm's board, it's all their suppliers as well.
Absolutely.
Fernando made the great point about how invasive DORA is, but actually operational resilience in the UK is similar. There's going to be a lot more information about the supply chain flowing into the regulatory centers from now on. And then ESG kicks in and asks those same suppliers to start reporting how much carbon they're providing to their customers in order to issue those bonds. So, you have these bizarre scenarios. We're going to have lots and lots of data about who's dependent upon whom and how the whole system is actually wired together. And that's the one community I don't hear the compliance community talking about much, but it's absolutely fundamental to have at this party. And to some extent, the regulators I think get it there because they approach them, but it's the large tech suppliers. Why aren't they at the table helping to get through some of these tough issues and help define those G standards and let them use the impressive might of their balance sheets to help break through what the banks need?
I'm not going to disagree with that, but we're back to Sultan's point about dialogue, and you need lots and lots of dialogue for the tech firms and the financial services firms to talk with the same language to each other, apart from anything else.
Yeah.
And I would use the case in point, the ISB standards that came out of COP26. I mean, for your average firm, it's millions of data points you are now going to have to collect, and you're going to have the governance around all of that. And the tech firms should be front and center in helping on all of that.
Yeah, and it strikes me that I'm in the middle of derivatives reporting standards version 2. After 10 years, we did a lot of work to screw it up for a decade. We're trying to fix it now, but we're about 10 years behind on those ESG reporting standards. There's one for every day of the year right now. So it's going to take a lot to pull that together. Sultan, can you help us, I think move to the next question, which is what are regulators really looking to the industry to do to help remove some of this friction? I mean, even though there are lots of agencies, there are not many people in them. And you guys are well outnumbered by everybody in the banks and in the supply chain and even in the standards bodies. What are you doing to help get people focused on these issues?
Well, first off, I greatly appreciate that you're recognizing how outnumbered we all are here. I don't think that's really quite as well realized. To Susanna's point a few minutes ago, there's a tremendous fight for the talent we need, right? Whether it's technical talent or domain talent or whatever. And so I appreciate that you called that out. And we're always hiring, so check us out on USA Jobs. But for us, it's coming to the table. That's a big starting point, right? You go back 10 years and there was a gulf. There was just this huge gulf. People couldn't even get in the same room and have a conversation. In the last 18 months or so, we've launched a series of programs, including rapid prototyping for regulatory technologies and supervisory technologies to begin to work together on building things. that actually help this discussion. I think, we need to create new standards activities, and we need to have everybody, that entire diverse cohort, participating in those discussions. That's a huge thing. I go all the way back to kind of version 1 of the internet, if you will. And I have very clear memories of it being in the early 90s, sitting in these rooms where people are talking about, okay, this is what HTTP should look like. And it was the public sector, it was the private sector, it was academia, it was the suppliers. Everybody was in there and they had common goals. And they figured out how to make that work. I'm just so confused personally that we haven't seen that model replicated in the financial services sector. I spent a bunch of time on the markets, and they did that. There were ways where people were working together to create common protocols for data sharing and common data standards, and ways where the data and the technology being developed actually had regulatory requirements built into it. So it wasn't an after the fact, grab a petabyte of data and then crunch on it for 90 days to figure out if everything was kosher, right? It was happening in real time as the transactions were occurring. Again, I'm a little confused why it's taken so long for banking in particular globally to come back to that, but there's a really interesting opportunity, I think, to do that. The biggest thing that we have right now, and I'm going to come back to Susanna's point because it cannot be overstated, is there are just not enough people with technical backgrounds and domain experience in these discussions. And it doesn't matter which community you're inside of, whether it's the regulatory community, whether it's the private sector at the board level, or even at the staff level. It's cross-cutting. We're going through this massive generational change in the workforce, and there is this gap that we are trying to fix right now. We have to have people who are equally capable of sitting in a boardroom and giving a presentation as they are at a whiteboard arguing why Monte Carlo is no longer sufficient as an algorithm for risk management, right? And the fact is the number of people who can do that is incredibly low. And so for me as a regulator, what am I looking for? I am looking for us to get better clearance and better collaboration from our partners and other stakeholders to make sure we understand what the goals are. We have to have a very clear conversation about understanding what our true north is. And that is even that basic of a conversation. What do we actually want success to look like can sometimes be a challenge. I hope the people listening here, especially between Fernando and me, will hear two very different perspectives. And that's great. That's what it should be. But those two different perspectives need to work together, right? And the great thing is we have a great relationship with his organization, and we talk to them all the time, and it's fantastic. But we have a different statutory requirement than a central bank, and that's a discussion. Would it be great if there were common data standards? Would it be great if every piece of regulatory or legislation had source code attached to it? That would be amazing. But we're very far away from that, and I don't see that changing really in the near future.
On that note, let's ask Fernando what his perspective is on that same very question. How do you look at this international approach to SupTech and RegTech alignment? You're mute.
A word on terminology. I think we use the term RegTech, SupTech. Well, probably RegTech, SupTech is used with different meanings by different people. For us, SupTech, RegTech are not really policy developments, or more is like a technological set of tools that could be used in order to improve actually the efficiency of regulatory compliance or the supervisory processes. Regulatory compliance will be the domain of RegTech, supervisory process will be the domain of SupTech. I think it's important to stress, and in what respects those two developments, there are, many jurisdictions are investing heavily on that. I'm sure the Fdic is doing that as well. But it's true that so far, actually, the sort of approach taken by different regulators have been relatively uncoordinated, although there is now a little bit of more appetite actually just to get into some cooperation related to this. That makes a lot of sense, of course. And the BIS, let me insert here a brief commercial on this, that the BIS is playing quite a prominent facilitator role in respect to this. But going back to the issue of regulatory developments, I think it's key, something that has been stressed by all of you, is the need of a comprehensive, consistent approach when dealing with risk posed by technological developments in the different types. I think it's clear that a number of things still need to be done. I think first, in terms of having a comprehensive and consistent approach to deal with the risk posed by big techs that affect, for instance, affect many policy domains. We have discussed about competition, about data protection. It's about eventually financial stability. Would actually be about monetary integrity if they issue stable coins. So we are talking about here a wide variety of policy domains that could actually be relevant. So we need actually to coordinate actions in different policy domains. We have actually just to basically to close the gap which currently exists, not only in terms of the sufficiency of regulatory actions, but also in terms of improving the consistency of different policy actions on different policy domains to correct the current relatively still piecemeal approach and to go for something which is more consistent, more comprehensive. The second important element here is about obviously international cooperation. I mean, technology and technological players are not confined within domestic borders. So we have to bring to the table actually basically different regulators in different actually jurisdictions. We actually need to get this international coordination. And certainly we need to bring to the table not only financial regulators, they meet very regularly here in Basel quite frequently, but we need also to bring to the table obviously competition, data authorities, and other actually authorities which have something to say about what is the best way actually to achieve this consistent regulatory approach in relation to all the risks that are posed by different technological players. And also, importantly here is actually this development in relation to stable coins of the new digital means of payments. That could actually be the most disruptive actually development if it is not properly regulated or properly controlled by public authorities. Of course, that type of instruments can actually bring benefits for customers, for consumers, but at the same time, they also bring important risks. I mentioned before consumer protection. I mentioned before issues about actually monetary financial integrity, could actually even affect the ability by central banks to continue actually ensuring monetary control. And those are important risks that should actually be tackled. I mentioned before the important initiative taken by actually the US President Commission. I think the FDIC was actually involved on that. I think it's a very important step forward just to put in place the right actual regulatory controls in relation to this. But probably this is not enough, and the public sector may need to do something else, like providing some sort of public utilities, these public goods that could actually be used in order actually to replace those private initiatives, but much safer public initiatives. I'm referring to the putting in place the right instant payment networks, and why not actually a well-designed central bank digital currencies. So those public goods, public infrastructure could actually be a helpful addition to regulation when actually thinking about what should be the response of the public sector to all those important, potentially beneficial, but at the same time relatively risky development that we are seeing in the private sector.
Yeah, thank you for those. And I think those are incredibly important perspectives on new things that are coming into the environment. What about existing problems, though? What about, I think about a year ago, your team put out a really good paper on regulatory reporting and how there are many different approaches globally to regulators collecting information. Where do we, Sultan mentioned issuing regulations as code, and thinking how you do a report, for example, is a great way to start. Do you think we can ever get to a point where you can get a BIS opinion on what digital reg reporting actually is?
Well, I mean, we are obviously paying much attention to those developments. As you said, we have already published documents on that. We are seeing that a number of authorities are now in the business of actually improving substantially actually the regulatory reporting. I think it's quite important, actually, particularly for prudential supervisors, to move away from, at some point, the current system under which basically all information supervisors receive rely very much on ad hoc reports by supervised organizations. So they have to start, I mean, they have to still actually sort of fill templates, right? At some point, we are going to move to a completely different world, which is already the case in some small jurisdictions around the globe, in which it's not about data reporting, it's about data sharing with the supervisor. It will be actually supervisors themselves to have access with obviously specific controls to actually the firm's databases and extracting from there actually all information which is needed actually for the supervisory processes. We are seeing already a little bit of that, and I think certainly is the future. I think we cannot actually, it's something completely inefficient, actually just to have to rely all the time on this regular report that every quarter, the firms submit to the regulator. Things are moving that direction, and more they are going to move in the forthcoming future.
And I guess that's the key, where you have the convening power to help them move that direction faster, better, cheaper, and safer. What do you see your role as in terms of shaping this new world, this new data sharing environment? Because I can't see how else we're going to get there.
Yeah, well, I mean, it's difficult actually just to sort of establish a sort of, how to put it, international standards in relation to this. When it comes actually to improve the efficiency of the supervisory and regulatory processes, the typical instrument that we use is that to facilitate the exchange of experiences. That is done by ourselves here in the Financial Stability Institute. It is done by other standard setting bodies like the Basel Committee itself. So it's about exchanging actually experiences, trying to put together what we have learned, and then in doing that actually just to facilitate sort of the modernization, in this case, of the data reporting mechanisms of different supervisory authorities. And this is actually proving helpful, frankly. It's not as spectacular as international standard will actually be sort of transposed into domestic legislation, because this is not really about legislation, it's about supervisory practices. But still, I think it's quite helpful. I mean, as I told you before, with all these networks that we have, for instance, from the area of Fdic, we have a network, specific network of that. That is a wonderful avenue actually just for people actually to see what other things are out there, what is the experience of other people actually using those tools. And in doing that, actually, I think we promote certain modernization of these supervisory regulatory processes.
Yeah, and look, I can't thank you guys enough for putting that paper out a year ago. It was really helpful to establish some basic principles and help get from theory to practice. But again, we're stuck in the engine talking about how wonderful the carburetor catalytic converter conversion process is going, and how it really should be electric, instead of talking about, wouldn't it be great to drive this car where we had all this information and we can know where we're going and we can get there fast. So I think that we're trying to now figure out how to raise that conversation. But this all gets back to, I think, a larger question that I'd like to move on to around the how regulators are really looking to enhance the safety and soundness of the marketplace, but also while maintaining an open market. Because you can't, as regulators, anything you say has to be done might have a competitive effect, and then competition is a critical issue for the regulatory community. So Susanna, back to you first. What does the compliance, capital C community think good RegTech, subtech regulation looks like?
Well, they have several hallmarks that they told us all about. Number one, which I'm sure both Sultan and Fernando will be delighted to know, is regular interaction between the regulator and the industry. That was absolutely exactly the number one. And then it was issues like international coherence, the need to ensure the good customer outcomes, and guidance and support on regulatory returns. So we are having a conversation where we are pretty much all agreeing with each other. But those hallmarks of good regulation come with a caveat here. When we asked then, the follow-up question, well, actually, if the hallmark of good regulation is for the industry and regulators to talk to each other, how often does that actually happen? Or how often is that actually happening? And so when discussing fintech products or fintech approach, only a third of our respondents said they'd actually spoken to the regulator about it. And when we're talking about RegTech, so something very close to compliance officers' hearts, it was only a quarter. Now, what we didn't ask was whether or not that was because it was not the firms going to the regulator to talk, or it was the other way around. But I would suggest if we are going to have this nirvana of good regulation on tech, both sides of this equation, so policymakers, regulators, and the firms both need to make that extra effort to talk to each other about all of this, and to talk to each other with the criteria of what is it we want to get out of this? What is it we want to achieve? To come back to your car analogy, how do we want the driving experience to be on all of this? I mean, whether or not it's got, got 6 cylinders or 12 is not really very relevant if you are the customer at the other end of all of this. They want to know how they are going to interact with their financial services firm, how they can pay their bills, whether or not to invest in Bitcoin or whatever it is. But you've got to make sure you are actually focusing on the outcomes that you want in terms of hallmarks of good, in inverted commas, regulation.
Yeah, and it was really interesting to see in your report. I think that figure 21 really stood out in my memory. The annual survey of compliance people as to what do you think the impact of this technology is on compliance continues to change, with the other bucket getting bigger. And I do wonder if this is a sign that we're having compliance shift from being a noun to a verb, and actually it's a broader conversation across the organization, because a lot of these challenges are in the boardroom. Yeah. And then these guys have to take accountability for it now. So compliance is changing shape. How do you think that's going to really affect the need for compliance officers moving forward?
I think the compliance of the future is going to be a slightly different beast, if that's the way to describe it. I mean, assuming RegTech really does deliver on all of the things it should, and there are some caveats to that as well, because we ask questions around, well, if you're not using the technology, why? And those sorts of answers were around poor infrastructure, poor investment, poor skills. So assuming you have got the RegTech in and it works and you're comfortable with it, that should, in theory, take away a lot of the rote compliance tasks, leaving compliance officers freer to do the value-add things around the strategy, around the business decision-making, around interacting with regulators. And I don't think we're quite at the stage where you can automate the interaction with regulators. For me, I think even into the future, that will be a head of compliance talking to their regulatory associates and the policymakers, and responding to the consultations, engaging with the regulatory process. That, I suspect, will be a senior compliance officer with the right skill set and the right resources, and able to rely on the information coming from their RegTech and Fintech deployed technologies to enable that strategic decision-making. So compliance is much more of a strategic asset to the firm, rather than someone who is saying, well, you can't do that. I think that is the way the future goes.
Compliance, the verb, is a strategic asset, but to be clear, compliance, the function, is almost a liability in a digital model, unless you have the right behaviors. But certainly for the analog model, if I'm using checkbooks and quills and those kind of things, I need to have people running around checking things. But the accountability lies with the seniors, and that it's all modeled, and if it's properly functioning, then it's a model-driven compliance function, and all that aggregating of information happens with the senior managers, correct?
That would be the rote part, but the interpretation of what comes out of, say, a RegTech solution, you are going to need someone with a compliance brain. I don't yet see any AI that can begin to do that, because it requires that skill set. It can happen automatically,
but it could certainly happen amongst business people in an agreed standard platform, like the common domain models are doing in the trade associations now. The language of finance is becoming digitized itself, and the digital gold is the way we express the product sets and the way they're exchanged. So the whole definition of how we think about digital really and who the keepers of it are is really starting to evolve here as well. But Fernando, I'd like to come back to you, please. How does regulation strike the right balance between the new players and the incumbent financial institutions? And a lot of your papers come at this from big tech or fintech, but what about banking tech, and what do you think the role is there?
Yeah. Okay, thank you. This is a scenario in which we have been actually developing some ideas and having recently published. Of course, it's a tough issue. I mean, it's clear that good regulation always aims, or should always aim at minimizing competitive distortions among players. But it's also true that in the area of financial regulation, rules are primarily geared towards meeting other objectives that are often considered of higher priority, like financial stability, consumer protection, or market integrity. In that respect, I think we have to recognize that the different entities may pose different risks when providing specific financial services. So for that reason, regulators frankly cannot treat all players equally, even if that could affect the respective competitive positions, right? So for instance, I mean, due to the need of protecting deposits and avoid bank runs, banks will need to be subject to prudential rules, but those prudential rules are not warranted in the case of non-deposit taking firms offering financial services. And conversely, as we discussed before, given the potential of, say, big techs or these gatekeepers to provoke excessive market concentration, special rules may need to be applied to them, but of course those rules may not be appropriate for other players, particularly commercial banks. So that is why we believe that it's not appropriate to seek a purely activity-based regulation under which all providers of financial services will always be subject to exactly the same rules. Activity-based rules, which are fine, should remain there, but they should be complemented with specific entity-based rules for the different players. And this is why, after having developed over the years a really far-reaching regulatory framework for commercial banks, we need to now conduct a comparable exercise for large technological providers of financial services that will fit well the specific risks that those entities pose for the economic and the financial system. And by the way, in doing that, the regulatory framework will also minimize competitive distortions created by the insufficient regulation of some large non-bank providers of financial services. So that will be my answer, right? I mean, I don't think it's right, this famous slogan, same activity, same regulation. This does not make sense from a public policy point of view. You need activity-based rules, but you need to complement those activity-based rules by specific roles for specific entities, take into account the risk that those entities actually pose that may be different to the risk posed by other entities.
There's a really important subtlety there. I think you pulled out very, very, very nicely. Sultan, I like in terms of the very few people we've talked about trying to address some really big, complicated problems. The critical thing is the business case, and it's the regulator's business case just as much as the whole industry's. How do you articulate the value here?
Well, it's a great question, PJ, and it's funny because when I started, we did a little bit of metrics to look at what the human cost and the actual organizational cost was for some of our processes, and one of them, a fairly intense part of our examination process, was 400,000 people days per year, of which a decent percentage of that was moving data. Well, that's just inefficient. That's there's opportunity for error and a bunch of other things, and so that's on us. But then you could go the other way and say, you look at the institutions and look at the amount of human time they spend on rote, technical tasks, right? And so getting back to one of your very first points about data as the new oil or data as the new currency, or whichever metaphor we're using this week, the fact is we still fundamentally have a regulatory system focused on human people process management and not on data management and data technology and things like that. And so for me, it's a really simple discussion. Anything we're doing needs to, number one, do a better job at making the system safer and sounder, regardless of if it's a 500-year-old bank or a 5-year-old neobank or a 2-year-old fintech. Number two, it has to be efficient for everyone, for me, for the other people in my organization, for the private sector side, and everyone in the supply chain. Having people do things that machines can do easily is there, because I want people, and there's a theme that we use at Fdic on around amplification. We want people who are experts to spend their time being experts. So if you are a capital C compliance expert and you've been spending decades of your life doing this at the highest level, I don't want you spending 45 minutes of every hour beating away at an Excel spreadsheet or whatever it is that you're doing to beat up on some old technology. I want you looking at the result of that data. I want you looking at the analysis and being able to come back, not focused on the trees, but look at the entire forest and say, okay, is the aggregate portfolio risk going up or going down? Is this one institution in a better position today than they were 3 months ago, 6 months ago, 12 months ago? We have to get to a point where we are able to be more thoughtful and have modeling that allows us to be more predictive about these things, because we have the right data, because we have the right tools, and because we're making the best use of the amazing people we have. So one of the coolest things about this community is there are honestly, some of the most amazing humans who know this space incredibly well, and they are hampered by bad technology. They're hampered by processes that aren't fit for purpose. And so as we think 5, 10, 15, 20 years out, a huge amount of the work that people are doing right now, where their hands are on a keyboard doing things, is going to disappear. I would love it if we wake up in the morning, I open up my iPad and I have a nice little dashboard that says, hey, over the last 24 hours, we've noticed this happening in the public markets. We're noticing this change in depository patterns. We're noting this process in lending repayment patterns. And this allows us to understand the shape and feel of the market in a way that allows us to then have our experts spend time being experts and not have our experts spend time, whacking away at keyboards. And so to me, if we've spent a lot of time talking about the risks of technologies and the risk of all these new things, there is also a significant risk if we don't do anything, if we don't take advantage of this, if we don't start to do things. And I have very serious worries that we are playing 2 decades of catch up in 2 years or 3 years or something like that. The banking sector has lagged so far beyond so many other markets in a lot of these ways that we really need to move them forward at an aggressive pace. And in doing so, we really have to do that. And so the business case is very simple. It's got to be safer, it's got to be cheaper, and frankly, it's got to be faster. And you put those 3 together, that gives you a very clear rubric for how to evaluate the programs and processes that are on all of our tables, right? A human process that takes 5,000 hours of people work to generate a single number that's 180 days out of date is less interesting to me than a process that takes no human hours and I get it 5 minutes later.
Yeah. But I think a critical point to tease out there at the end was your risk statement. It's got to provide payback and it's got to be seen as a safe bet, which requires the support to say, yes, others like me are also doing this, because it is a herd-based mentality, not an individual business decision at the end of the day.
I think it's a herding of cats in many cases.
Many cats of all shapes and sizes. So amazingly, we're at the end of time, but I want a 1-minute summary from each of you, please. Susanna, the final summary question I'd like you to ask is really in the name of this panel, being enabling a healthier and competitive environment through the harmonization of tech regulation. What did you learn on this panel?
What I learned is, and something I would absolutely endorse as well, is that regulators and firms need to carry on talking to each other and to invest their time with each other, because that's how we will get all of those great improved efficiencies, optimized reporting and data analytics. All of those kinds of things will only come about if the firms and the regulators continue to engage with each other. And I think all of us need to get better at that. I will leave it at that, because our data shows it's not quite happening yet. So that's something to work towards.
Thank you very much. Fernando, what's your perspective?
Well, I think this conversation certainly has been quite illuminating. Basically, we all agree technology brings a number of relevant benefits, very important benefits. So it's important actually to take advantage of them as much as possible. In order to do that, we have to be aware, of course, of the risks that also bring technology. And those risks should actually be tackled properly, implying essentially that we need a proportionate approach, we need a global approach, and also we need an integrated approach, because again, we are talking about a number of policy domains which are affected by those developments.
Thank you. Excellently said. Sultan.
For me, I can't agree more with what the other 2 panelists said, but I'll say, the last point I was trying to make was that we've passed that line in the sand where the risk of not doing anything is now greater than the risk of what's there. And so we really do have to get our collective acts together, and we need to do a far better job of encouraging more people, especially people with the right technical domains, to play in our sandboxes with us.
Yeah. And I would add, listening to all of you, that I've learned a lot from your perspective, but in particular that we can sell this, that there is a bigger business case here. We can actually make a difference. It is possible to cross that bridge, but we got to go across it. We can't just talk about the fact that we need to. So I'm going to leave it at that, and I will hand back to Alessia. Alessia, thank you very, very much, and thank you to all of you for putting up with my facilitation style.
Thanks everyone. Thanks Sultan, Susanna, Fernando, and Jay for being out here with us today. It's been a pleasure to have you, and thanks for the discussion. It was very, very interesting. Next up, a presentation on unlocking the potential of blockchain in banking by Laurie Keogh, Global Director, Digital Assets and Blockchain Advanced Solution at BNY Mellon.